Welcome to This Explainer. Today, we're peeling back the layers on the carefully engineered financial machine hiding right there in your wallet. You probably think a credit card is simply a convenient way to pay for things. You use it because it's way easier than carrying cash, you earn some rewards, and hey, maybe you get a little purchase protection. But by the end of our time together today, I promise you won't look at that little plastic rectangle the exact same way ever again. So picture this. You're standing in a store. You find a sweet pair of headphones for $180. You pull out your credit card, tap it, and you see that tiny little notification pop up, approved. Now, notice what didn't happen just then. You didn't physically hand over cash, you didn't watch $180 actually leave your wallet, and you didn't see your bank balance drop right in front of you. That delayed financial pain? Well, that's the very first trick. See, when you spend cash, the loss is immediate. With a card, the headphones are in your hand today, but the financial consequence arrives much later. And later is incredibly powerful. Actually, an NBR study found that people who unexpectedly received a new credit card temporarily increased their total consumption spending, even if they weren't financially constrained at all. Here is the absolute crucial point. A credit card isn't just a convenient payment tool. It is a deeply sophisticated system designed to monetize your behavior. Every single swipe, every tap, every monthly statement you get is part of a business model engineered from the ground up to change your relationship with money.
Section 1. Inside the financial machine.
When people say credit card, they usually imagine one simple product. But man, that couldn't be further from the truth. A credit card is actually 5 distinct systems working together simultaneously. First up, there's the transaction machine, processing the payment. Second, the rewards machine, handing out those points or cashback. Third is the borrowing machine, which activates the exact moment you don't pay your entire balance and magically turns your transaction into a loan. Fourth, the behavioral machine, which actually changes how a price feels to your brain. And finally, the data machine, logging every single detail about where, when, and how you spend to help institutions manage risk. It's a payment system, a lending product, a rewards ecosystem, and a behavioral tool all rolled into one. And this brilliantly illustrates the core truth of the whole industry. Banks aren't just processing your payments, they are literally monetizing how you act. The physical card is just the entry point. Your decisions, well, those are the actual product. Section 2. The Trap of Rewards. Look, we all love getting something for nothing, right? But it really helps to understand why the bank can even offer this in the first place. These rewards are actually funded by things like interchange fees. Those are the fees that merchants pay. And well, they often pass them right back on to you in the form of higher prices, which was perfectly highlighted in a 2026 NBR study. So let's look at the math here. You might feel like you're totally winning by getting $20 back on a $1,000 purchase. It feels great. It feels like the bank is literally just handing you free money for going about your daily life. But here's the catch. If that reward acts as bait and encourages you to spend an extra $200 you wouldn't have otherwise spent, it becomes a psychological discount attached to extra consumption, not free money. The economics completely flip on their head. You aren't beating the system. The rewards machine is working exactly as intended by incentivizing higher overall spending. Section 3. The True Cost of Borrowing. Let's look at what happens when you don't pay off your balance, and that number turns into revolving debt. Because this is where the machine becomes wildly expensive. According to May 2026 Federal Reserve data, the average APR for accounts assessed interest is a staggering 22.15%. Just think about that number for a second. In the financial world, a guaranteed 22% return is absolutely astronomical. To put that into perspective, if you carry a $5,000 balance for a year, that balance generates roughly $1,107.50 in pure interest. That is over $92 a month you are paying just for the privilege of holding on to the debt. Remember what you originally bought with that $5,000? Maybe it was groceries, maybe a vacation. Those things certainly don't become more valuable just because you borrowed to buy them, but the debt to acquire them becomes incredibly expensive. The groceries are eaten. The vacation is long over, but you can end up paying for that exact same spending again and again. That is the ultimate paradox of credit cards. You experience the joy of spending the money once, but if you aren't careful, you will pay for it for months or even years. Think about the stark contrast between two different types of customers here. Customer A pays in full and walks away. Boom, done. Customer B carries the balance and pays interest. Let's say they both go in and buy a $100 item. The store sold the exact same product. The customers walked out with the exact same product. But for the financial machine, Customer B is significantly more valuable because their single transaction has a much longer, much more profitable life. And this is exactly why revolving credit is the true profit center. Getting you to use the card is only step one. Getting you to carry a balance is the ultimate goal. This creates what we call the floating price effect. You see the price today, sure, but if you don't pay in full, the final economic cost floats indefinitely into the future.
Which brings us right back to that behavioral machine we talked about earlier. Just look at these two numbers. Your brain interprets them very, very differently. When you see a $1,000 balance but a tiny $35 minimum payment, it psychologically shrinks your immediate obligation. Version 1 of your brain goes, yikes, I owe $1,000. Version 2 goes, oh, I only need to pay $35 right now. By making the obligation feel smaller, it makes it significantly easier to just keep spending.
But honestly, beyond the interest itself, the ultimate hidden trap is opportunity cost. And by that I mean, the money you spend servicing debt is money that absolutely cannot compound and grow your future wealth. If you are paying that $1,100 a year in interest, that is $1,100 that cannot be sitting in an investment account working for you. You aren't just paying a lender, you are actively preventing yourself from building your own future wealth.
We also have to acknowledge that this risk hits absolutely hardest when cash flow is tight. The Fed's 2025 survey showed that for those finding it difficult to get by, credit card balances increased by more than 35% since 2023. When you are already struggling, revolving debt becomes a dangerous wealth trap that's incredibly hard to escape. It becomes this compounding cycle working entirely against you.
Section 4. The one variable. Now, despite all this, credit cards aren't inherently evil. Used carefully, they're super useful tools. There is exactly one variable that completely changes the economics of this entire machine, and that is your repayment behavior. It simply comes down to whether you pay the statement balance in full every single month. If you do, you collect the rewards and use the transaction machine while completely disabling the borrowing machine. The most important number on your card isn't the rewards percentage at all, it's the APR combined with your repayment behavior. Once you really understand the machine, you can change your behavior. You stop asking, hey, what's my minimum payment? And you start focusing on the total cost of the purchase. You stop seeing a $10,000 credit limit as $10,000 in cash you own, and you start treating it as what it really is, expensive borrowing capacity. By shifting that mindset, you take the power back. Because the next time you tap that piece of plastic, you really need to ask yourself one final critical question. Are you controlling the card, or is the card quietly controlling you?